let's now understand what really are commodities. Let's understand the definition of commodities. And in economics, a commodity is an economic good, usually a resource that specifically has full or substantial fungibility. Other definitions of commodity include something useful or valued, and an alternative term for an economic good or service which is available for purchase in the market. Commodities are interchangeable, they are limited in supply and are often traded on exchanges. Commodities can be categorized as either hard commodities or soft commodities. Hard commodities are those that can be mined or extracted from the earth, such as metals and petroleum products. Meanwhile, soft commodities are those that are grown and cannot be stored for extended periods, such as coffee, cocoa, orange juice, and sugar. But to understand all this and more in greater detail, we are now joined by Mr. G. Chandrashekhar, who is an independent commodity expert now joining us. Sir, thank you so much for taking your time out and speaking with us here on ET Now on this weekly edition of Commodity Classroom. And first up, since you've tracked commodity market for so many decades now, help us understand and give us a short brief of the history of commodity market and how have different types of commodities evolved over the last few years.
Ever since man or humankind learned to harness natural resources, commodities have been with us. Okay, but commodity markets, when you talk about, came much later when trading started in terms of money. Okay, and commodities are usually defined as goods with economic value. They are highly standardized products. They are produced in bulk, consumed in bulk, etc. And they are usually homogeneous products. Because different regions of any country or different regions of the world have different natural resources and therefore different endowments of commodities, trade had to take place. Goods had to travel from surplus region to deficit region. And that is how the markets, commodity markets, came into operation. This is the first proposition. When commodity markets came in, we also found huge price volatility. Depending on weather conditions, depending on other risks, etc., natural calamities, there was price fluctuation. There were shortages, there were surpluses, and therefore this hurt the value chain participants, and therefore came another market called the derivatives market or the futures market. Therefore, you actually have two markets. One market is a physical market, which is a physical production of agriculture commodities, physical production of energy products like crude oil, physical production and trade in, say, gold, silver, etc. The second market, which is the other side of the coin actually, is a derivatives market or the futures market, which actually helps the producers or processors or consumers of commodities to manage their price risk, or what is called hedge their price risk. Because when you take a trading position, prices can fluctuate. And particularly when you take a forward position, prices will fluctuate given various factors that impact commodity markets. For example, let me talk about economic growth. Economic growth impacts commodity market. There are some commodities called growth commodities. There's a positive correlation between economic growth and commodity consumption. For example, steel, for example, cotton, crude oil or energy products. As economic growth rises, consumption of these commodities also rises. Therefore, they're called growth commodities. Therefore, economic growth is a primary driver of commodity market. The second one is geopolitics. And the geopolitical factor actually has come into the market very, very recently, probably in the last 50, 60 years or after the First World War. Yeah, let me put it that way, because during wartime, during geopolitical uncertainty, there is a huge risk of a loss of supplies or disruption to supplies, and therefore commodity prices would actually rise. So geopolitics is the second one. Third one is weather. As far as agriculture commodities are concerned, weather is a big driver of agriculture commodity production. We have La Nina, we have El Nino. In our country, we have drought, we have flood, excess rainfall, shortage, whatever, all those kinds of situations. Therefore, these are the three major drivers. But once currencies came into operation and there were exchange rates, for exchange rate or currency factor also started to impact commodities. And last but not the least is the monetary policy. When central banks were established, they had their own monetary policy. Often they had very accommodative monetary policy, huge liquidity, low interest rates, etc. Other times, to control inflation, they tightened the monetary policy, raised interest rates, etc. All these factors start to impact commodity markets and commodity prices in particular. And this has actually has, what should I say, accelerated in my view over the last 20 to 25 years. The impact of economic growth, monetary policy, geopolitics, weather conditions, all that has accelerated in the last 20 or 25 years. And this is likely to continue for a very long time, because given the very nature of economic activity, geopolitical tensions amongst countries, etc., markets will continue to remain volatile. Prices will continue to fluctuate. What is a commodity market without price fluctuation? Price fluctuation is the essence of actually commodity markets, and therefore that makes price risk management very, very important.
Understood. We get that point, sir. Let's now shift focus to various factors that influence commodity market, and you did talk about that in little detail. Let's talk about the supply and demand factors. Supply and demand are the fundamental forces that drive commodity prices. All other things being equal, an increase in supply or decrease in demand for a specific commodity will lower its price and vice versa. Apart from this, geopolitical situation, technological changes and climatic conditions are some of the other factors that influence commodity markets. Sir, I wanted to know, you did talk about the factors that influence the market, but also wanted a sense of how important commodity market is to the world economy. Several economies of the world are dependent on several commodities. For instance, OPEC Plus, which is dependent on crude oil reserves. Help us understand the importance of commodity on the world economy.
Absolutely. The world is looking at some of the major commodities like energy products, for example. Energy fuels economic growth. Energy in any form, whether it is crude oil or natural gas or coal or biofuels or even solar energy, wind energy, nuclear energy, all kinds of energy products actually fuel economic growth. Therefore, energy products are extremely important for economic growth and for the global economy. Then you have metals, for example, like steel, infrastructure projects, construction, where huge amount of steel is used, cement is used, copper is used, aluminium is used, base metals are used, for example. And therefore, these metals also play a significant role in the commodity markets. And as I said earlier, different countries have different endowments of natural resources. And therefore, some countries have abundant natural resources. Some countries do not have that kind of abundance in natural resources, be it energy product, be it metals, or be it agriculture crops, etc. And then therefore there will be trade, and therefore that's what makes the global marketplace so interesting. And then therefore the point I want to make, as far as India is concerned, commodities are extraordinarily important in my view. And over the next 25, 30 years, India's economic growth is going to be significantly driven by commodity markets. India is already a major producer of commodities, major processor of commodities, major consumer of commodities, and major importer or exporter of commodities, a variety of commodities, a range of commodities. And this process will accelerate over the next 25 to 30 years because the commodities are going to fuel our economic growth. What happened to China in the last 30 to 35 years? Huge amount of commodity production, commodity consumption, and commodity trade. In some way, China is a mover and shaker of the global commodities market. We are not there yet. We are not in China's league, but I think we are moving in that direction, and that's what makes commodity market extremely important for our country. We need more energy products. We need more steel. We need more copper. We need more aluminium. We need more agriculture commodities to ensure our food security and nutrition security, etc. Yeah.
Economies of the world are dependent on several commodities, and China is clearly the mover and shaker of several commodities. But let's now talk about commodity cycles and how they have emerged over the last several years. Any market cycle can be classified into four phases, right? Rise, peak, dip and bottom. International commodity markets experienced a major boom and bust cycle starting in the early 2000s, and commodities ranging from base metals to energy to grain experienced synchronized surge and collapse in prices over this period, exhibiting common cycle across several commodity sectors. In particular, over the period 2006 to 2008, prices, for example, of copper and crude oil and wheat increased by nearly 75 to 110% respectively. This upswing in prices was disrupted by the global financial crisis, with prices declining to nearly early 2006 levels by the end of 2008. The post-World War II era also experienced several cycles, but sir, also wanted your thoughts on how do you really assess whether a new cycle is starting or ending, and is it possible to time the cycle?
Very, very interesting. It's like this. It is rather difficult to say when would a commodity cycle start. It is possible to reasonably predict its end, but it's a little tough to foresee the start of a commodity cycle. Yet there are situations. Take for example, in the last 30 years, from the early 80s, even 40 years for that matter, China started to grow. China started to grow and had ravenous appetite for commodity consumption, energy products, all kinds of metals, and of course, agriculture commodities. That is what drove global agriculture commodity market, because there was one giant economy waiting with huge appetite to swallow all commodities that are offered. Okay, and therefore that is possibly China-driven China-driven commodity boom, which lasted almost 30 years, is possibly coming to an end. That does not mean that China is not going to be any more influential in commodity market. They will continue to remain influential. They will continue to impact the market, but the vigor, the strength, the robustness with which China impacted global commodity markets over the last 30 years is obviously starting to wane. This is a space which India is most well poised to fill, but that requires a lot of preconditions to be met as far as our economic growth and commodity consumption is concerned. You also talked about a huge spike in prices between 2006 and 2008, or even from the early 2000s. One big reason all of us must remember for those kinds of price spikes is not only those five factors that drive commodity market that I talked about earlier: economic growth, geopolitics, monetary policy, currency, and weather. These are the five major fundamental factors. There is a sixth factor. The sixth factor is funds, hedge funds, speculative funds. It is, if you look at history, speculative funds have often boosted commodity prices, or they have also artificially depressed commodity prices. Therefore, the sixth factor is as important as the five factors that we talked about. Therefore, it is important also for us to track how much is the speculative money that is going into the commodity derivatives market. And that is why you have a market regulator. You have a market regulator who has to ensure that there is no excessive speculation. There is the markets are not negatively impacted by too much of speculation or flow of too much of speculative capital or unlimited flow of capital. And therefore that is also another factor. The fundamental factors of demand and supply will continue to operate. But when you allow speculative capital to come into this market, it will have an exaggerated impact. Speculative capital exerts an exaggerated impact on commodity prices, whether on the upside or on the downside.
Mr.
And therefore, these are
Chandrasekhar,
factors
thank you
that
so
we need
much.
to bear in mind.
Unfortunately, we are out of time, but we'll touch base with you again in the upcoming editions of Commodity Classroom. Thank you so much for taking your time out and speaking with us here on ET Now.
If you like this video, then like, share and subscribe to ET Now.